I'm Brent Sullivan, and this is The Albatross. In 1924, the first mutual fund, called Massachusetts Investors Trust, launched with $50,000 under management. 25 years later, a former magazine writer, A.W. Jones, created the first hedge fund, which was, incidentally, a long-short fund. In the late 1960s, Michael Jensen looked at mutual fund performance and found it wasn't that great relative to a naive index. Those 50 years of investing in the United States were about active management, stock picking. In the 1970s, that changed, and the investing world split. One camp systematized active management, turning stock picking into engineering. The other camp stopped picking entirely and just bought the whole market after Jack Bogle and others introduced the index fund. Another 50 years have passed, and the best ideas from active management and passive management are fusing. This is driven in part by rapturous equity growth, and whenever that happens, a lot of people end up with most of their wealth in one or two stocks, and they start thinking very hard about risk and tax. My guest has had a front row seat to all of this for the past 3 decades. Paul Bouchey is the editor of the Journal of Wealth Management, managing director of applied research at Morgan Stanley, and previously the chief investment officer at Parametric Portfolio Associates. Welcome, Paul.
Yeah, absolutely. It's so interesting. And I think direct indexing and tracking an index while doing tax management in a separately managed account kind of founded in the 90s. And Parametric was right on the front edge of that. You have this growing trend towards passive and index-based investing, and then, exchange traded funds. And that whole massive wave has been a multi-trillion dollar, tens of trillions of dollars, and a huge shift in assets away from, essentially active mutual funds into kind of these more passive, more tax efficient vehicles. And I would say like direct indexing has been like a small little chunk of that. And, we were always like, if we can go from a 1% share of that to a 1.2% share, we'll grow into a, $600 billion firm. And then that's really kind of what happened. So I joined the firm 20 years ago and we had 14 billion under management. And I think, today it's over 600 billion. So it's been an incredible growth trajectory over my 20 years at the firm. But if you go back, for the 10 years before that, it started in 1987 really as a quant active manager, systematic investing. In the 1990s, Parametric raised $1 billion and had a reasonable asset base, but was having difficulty in the performance track record. So the 5-year numbers looking really tough. But they had one client who was a family office, and they had an index-based mandate. So they had a couple indexes they were tracking, and they weren't following the multi-factor approach of Parametric. It was implementation only, but they would call Parametric and ask us to do trade if there were any positions that were a loss, and if we could do trades to rotate out of those. And so I think at the time there were, maybe 10 employees, and Brian Langstrat, who was hired directly out of UW with a bachelor's degree, and he would just manually do these trades and kind of try to balance the sectors. They didn't have any risk model or optimization at the time. But they would just mechanically do this loss harvesting every quarter. And the client loved it because they got the index exposure, they had a really cheap fee, and they would get this tax benefit. And, Brian Langstrat later became the CEO of the firm. At one point, the firm was like really in trouble, sort of like, if the one big client calls, then, the firm will be done basically. And so what they did was they did a search for a new director of research and a new head of portfolio management. They hired David Stein and Tom Cito, and the mandate was to kind of fix the strategy.
They were bringing in these heavyweights to come and do quant analysis and really right the ship.
Yeah, exactly. And so, but they came in and they're like, hey, what's this tax management indexing? This is really great. Let's add a risk model and a portfolio optimization process and really systematize this and sell this. And so, over the next 3 years, basically the firm flipped from, 80% active to 20% passive the other way. And then the growth came in the index space.
Did this mean that the client base shifted? I don't know. Was the multi-factor, was it institutional focused or was it private wealth?
it was a big shift from institutional into private wealth for sure. And so you kind of think about Russell at the time was big consultant doing manager research for the top 50 largest pension funds. And so it had a culture of really institutional, great portfolio management kind of culture. And so, yeah, they were coming out of that.
I wonder what that transition was like. I mean, it's hugely different.
Yeah, and I think even more in the we were really focused at the time. The account minimums were not that low. It's like $10 million with an account minimum, reasonable account minimum back in the early period, and so we were really dealing with either independent advisors that had very wealthy, high net worth clients, the corner office of the broker dealer space, where they had the bigger clients and the bigger practices, or the family offices, which, we're starting to, there's a big rise in independent family offices and multifamily offices as well during that period. And, those are like pools of assets that don't even have websites. Like you don't even know about them. So very, very kind of bespoke and in trenches. Um, I was pretty excited when I was moving from Russell to Parametric. I'd worked at Russell for 10 years and got interested in taxable investing.
And so you joined in 2006, is that right?
Correct. Yeah.
Okay, and then so you talked about how there's like kind of these two crests, maybe it was the early 90s, there was equity appreciation, late 90s, equities appreciation. And my instinct is that the tip of the spear in tax management is concentrated wealth and managing kind of the thorniest circumstances that clients have, and then eventually migrating into daily and routine portfolio management.
Yeah. No, I think that's right. And I think the in the early days of Parametric, as they were switching to this tax managed indexing approach, they were very conscious to, you know, publish research papers on it, speak at conferences. And that's kind of where I had my kind of wake up moment is I went to a wealth management conference in Atlanta while I was at Russell, and I saw David Stein and other from Parametric speak and other people speaking on wealth management in general. And here I was, pretty, still pretty early in my career, being trained up on all the things about modern portfolio theory and how it applies to institutions, asset allocation, optimization, asset liability management, performance measurement, all these kinds of things. And here in this wealth management context, it's suddenly like you have all these other issues. So I had kind of two dimensions I was working with, returns and risk and creating these frontiers and, doing all this analysis. And suddenly there's this third dimension, like tax, like the major, major thing that institutions don't have to deal with. And it kind of changes everything. I quickly learned that a risk tolerance questionnaire is not going to go very far in a wealth management practice. You need to understand the goals of the investor. And so I think during this time in the 90s, the backdrop is there's this tremendous creation of concentrated wealth through the dot-com era, along with this rise of passive investing, index investing, ETFs, and even robo-advising. And so myself and, other people are trying to figure out how to take the tools from modern portfolio theory and make them relevant for a taxable investor in a financial planning context. One of the best examples was Bill Sharp's financial engines that kind of came up in the 90s. I'm like, hey, let's take all of this optimization, Monte Carlo simulation stuff and really apply it to the goals of, individuals and take tax into account and asset location and try to do the whole thing. So I thought there was some really good efforts to bridge that gap during that period.
There was also, I feel like this countervailing force in the early 90s, which was the arithmetic of active management. And then I think right around the same time was Arnott and Jeffrey, 1993, of course. I mean, it's like suffice it to say, this took hold. And I think this is just a continuation of the passive trend. And then I think if you kind of move through the early 2000s, we get introduced to the SPIVA after tax performance reports. This seems like another sort of watershed moment to me, not as big as the introduction of the index fund, but another change.
Yeah, and I think it's kind of, you know, rigorous performance benchmarking, I think is kind of a big evolution. And then the investment management world starts to get professionalized a little bit through mutual fund. And okay, you're a mutual fund, but now if I'm a Russell consultant, I'm gonna like categorize you. Like, okay, you seem to be a large cap growth manager. And so I'm gonna measure you against the Russell 1000 growth index. It's like, like a simple growth manager earned 10%, you earn 5%, doesn't look great anymore. That becomes a great argument for going passive. And so I think, extending that to taxes and saying, hey, now that you know how hard it is to earn a 2% alpha and how rare that is after fees, that became a very strong argument. Kind of brings me back to a story. One of my first managers at Russell, Andy Turner, in the research team, I was asking him questions about the capital markets, and he would say things like, you know, people in the investment world get confused about the purpose of the capital markets. They think, hey, I'm going to make investments. The purpose is to give me returns. But the purpose of the capital markets is to provide capital to entrepreneurs and investors and to offload risk. And so as the investor, you come into the capital markets, for sure you're getting the risk. You should come into the capital markets thinking, this is a harsh environment that I need to survive.
This makes me think when an advisor is explaining index exposure to a client, the story is a lot easier than an active story. Would you say it's accurate that if we take the passive ethos that Bogle kicked off in the mid 1970s, that really tax efficiency is really just trying to wring additional value out of the same type of exposure?
Yeah. Yeah. I mean, one of the ways I think about it too is, um, if you're going to be doing kind of additional tax management, maybe to produce extra tax losses, then, one of the areas that's kind of ripe for that is the equity portfolio, because you can hold a lot of stocks. They have a lot of dispersion and a lot of volatility, but also because people tend to hold equities for a long time. And so if I'm going to basically be storing some tax liability in a part of my portfolio, the unrealized gain, and trying to hold it for decades and decades to defer it, um, one of the natural places to store it would be the diversified, you know, large cap, broad cap equities. There's this kind of performance game that investment professionals play. So if I'm a hedge fund manager, I'm like, okay, I built this smart thing. I have this magic box. It can produce profits, and look at the track record. Look how smart I am, and I'm going to make you a lot of money, and then we're gonna go. And then you would hire me and be like, the magic box isn't working after 3 years, so I'm going to fire that person, go hire another person. And so that's kind of like the performance chasing game. I think investors kind of got tired of that. You have rigorous benchmarking now. And so I think switching to passive is like, hey, I'm just going to cut my fees and for a huge chunk of my portfolio. I'm going to get out of this performance chasing. Maybe I'll keep it on the edges and some satellite areas, but for the core of my portfolio, I'm just going to stop playing the game. Now on the advisor side, it's like, yeah, I'm going to stop playing that game too. Like, why would I give advice to hire XYZ manager and maybe get us both fired when I could get passive? But I do need to find other ways to add value. Tax efficiency is another way to add value. At the core of it is was this concentrated wealth creation. And for a while there, I think tax management became a very kind of hot topic. A lot of papers written about it. Journal Wealth Manager was launched during that period to capture that literature. And there was a lot of kind of momentum along these different research lines. And then I think there was kind of a quiet period, like, that like people launched a bunch of tax managed mutual funds and they launched a bunch of ETFs. And then it's like ETFs are really powerful. They're very tax efficient. They're very diversified. There's a big growth and profusion in that. And so people could kind of forget about tax management a little bit or focus on other parts of it. And there's been advancements over the years, I think, especially, but I think the more recent period, the last 5 years, it really has felt like we're getting back to the 90s in a way. Like there's this big concentrated wealth creation happening with AI companies and tech companies. People are starting to talk about how to solve this concentrated wealth problem, how to deal with taxes.
I mean, now we're talking about really rigorous after tax performance measurement, but also things like tracking, like really deliberate replacement selection.
If you're just a smart person, and you have a spreadsheet and you're managing a couple accounts, you can do a reasonable job with no tools. You might do kind of a stratified sampling by sector, industry, or get kind of fancy in your spreadsheet, do some other things. But you, I think the rigor is kind of this higher order thinking, like a little more scientific engineering approach. Like, let's build a model of the world. Let's take each stock and build a model of its risk and how all those risks interrelate. And what they're doing is they're doing kind of what nutritionists do. You're eating Thai curry and I'm eating Indian curry, but like, how much carbohydrates, how much protein, how much fat, how much vitamins, how much micronutrients, and so you can kind of take what's a complicated set of ingredients and distill it down into a set of, underlying nutrients or factors, and kind of understand a little bit about, is that healthy or not healthy? But if you have an optimization model, you can say like, okay, I'm going to balance these 85 things all at once according to this objective function. And I'm going to put these constraints on it to make sure I don't violate any of these precepts, and use kind of this more rigorous, higher order, more systematized way of kind of doing things.
Replacement selection is something that comes up a lot. I also want to talk about tracking error management as a higher order concept. Replacement selection, I feel like the common thing that comes up for folks who are not steeped in this stuff all day long is like, oh, I'm gonna tax loss harvest NVIDIA. I have to find a replacement for it. And, gosh, if I just select something in the same sector, am I going to end up with something like Snap? Completely different exposure.
So I think, yeah, I mean, like sometimes when you explain, you say, okay, yeah, Pepsi's at a loss, you sell Pepsi, you buy Coke. GM's at a loss, you sell GM, buy Ford, and so, but there's like those like really nice, clean replacements don't, you know, don't exist everywhere. Each one of those things has all of its own idiosyncratic risks. So you take all the Pepsi and you replace it with Coke, but then Pepsi CEO has an announcement the Pepsi stock's going to move, but the Coke stock is not going to move. And so you still, even in those like really perfect sounding replacements to, two beverage companies in the same industry, they're not perfect because they can have idiosyncratic things. And so one of the ideas of kind of moving to a factor-based view of the world is saying like, well, actually, instead of viewing this as 500 stocks where I need to do one-to-one replacement, I'm going to view this as 60 industries, but also a bunch of portfolio characteristics. So I'm going to view this portfolio through the lens of how much of the value tilt is the portfolio, how much of a company size, how much stock price momentum. As long as I get this profile correct, this kind of nutritional profile, I could have these 20 stocks or these 20 stocks, or, I could start swapping stocks around or underweighting, overweighting stocks. And as long as the factor profile looks good, then I'm good.
So I'm smiling here because I'm thinking of Moneyball. It's like, you can't get all of the individual players, but in the aggregate, if you can reconstruct this exposure, then sampling is actually a lot less risky. Returning to professionalization, this is really, I think the consequence of this effort is that tracking error is tighter.
Yeah. Yeah. Like parametric. Okay. We started out, just had a, analyst kind of trying to match the sectors. Then we added a risk model. Then we managed the money through the tech bubble crash. And we realized, wow, we thought a plus or minus 1% sector exposure was fine. But now we know it needs to be, 25 basis points, and it has to be applied at the sector and industry and country level, and, then we lived through the global financial crisis. Like, yeah, we thought that plus or minus 1% on the stocks was okay. But in the GFC, we found that was too risky. So we have to tighten up those risks. And so sometimes we'll describe the approach as kind of belt and suspenders. So the belt is the risk model. So that's all the quantitative stuff, the optimization, and your forecast of tracking error using the risk model and your portfolio differences. is something that you can manage. And then you apply all these other constraints. Say, yeah, the risk model is great. It says we're well under 1% tracking your budget. That's good. And I'm still not comfortable. I still am going to insist that the portfolio has very similar stock weights to the index within plus or minus, say, 0.5% or 0.25% in some cases. And the sectors have to line up within plus or minus 25 and this and this and this. And so even if all your risk modeling breaks and something truly unique happens, I think COVID was a great example. You build this sector model, industry model, and COVID hits, those industries aren't as relevant. It's like food companies aren't all behaving the same. It's whether you deliver food or have food out of the store that matters. And so suddenly there's big divergence within your industry groups. So I think, when things change and break, you're still going to track because you have these extra constraints on the end.
Okay, and then there's also this other flavor of innovation happening, I would say, from the mid 90s into the mid 2000s, and we're talking about systematic tax loss harvesting. This is not a year-end thing anymore. It's not a quarter-end thing. It's not even a monthly thing. It's more than that. It's in some ways, I think of it kind of like tax optionality. I think of it almost like a put option. The value of the put option is a function of market volatility, things like that. But you've really professionalized that aspect too.
I think tax management and tax awareness and tax loss harvesting was kind of in the wealth management industry, and really good high net worth advisors would do that. And they would usually do that as part of a cadence of advice. Hey, first quarter, we're going to meet and talk about your asset allocation and set your goals, your risk tolerance. Great. Second, we'll maybe do some financial planning. And then, okay, fourth quarter, it's tax time. So we talk any tax trades we need to do, and then we're getting ready for the tax return. And so there's kind of part of this advice cadence. So you end up kind of as an advisor doing tax loss harvesting maybe once a year. I sometimes joke that Parametric is the Seattle-based technology company that just happens to monetize its software through investment strategies. It's like really the building the code to be able to provide mass customization of accounts. I think that's one key difference for a tax manager, and that's coming from that quantitative investing background really helps.
Of course, like the latest innovation over the product innovation, the literature's been out since some early 1980s. Constantinides wrote about this. And of course, I'm alluding to long short, but over the past 5 years or so, this has really become a product. And my intuition is that this is a function of concentrated wealth. And another thing is just active management making its way back into the investing landscape.
At the beginning of my career, Parametric, we weren't well known. It wasn't like Parametric's a household name or people even knew what we did. They didn't really have a name for it until I think Dave Nadig at the ETF.com conference named it, and he called it direct indexing. I think that was kind of step one for kind of raising awareness of what we were doing. I think the second big thing that happened to kind of increase the awareness of direct indexing and kind of kick off this new interest in tax management. So Parametric was purchased by Morgan Stanley, Curio was purchased by BlackRock, 10 or 12 mergers and acquisitions over the course of 2 years. And each one of those creating their own financial press and like teaching people about what direct indexing is. And now it's like we're playing the same game, but it's at a kind of a much higher stage. We're backed by these large banks or large trillion-dollar asset managers and just competing at a much higher level. And then the third thing is this whole interest in tax-aware long-short management. And this is something that, we had done at Parametric on a kind of a one-off basis for family offices. So I had several clients that we built custom long-short solutions with in 2015 and 2018. Even before my time in the late 90s, we ran a long short for a client that was tax aware. And then, like first quadrant, which was where Rob Arnott was before Research Affiliates, they were interested in this tax-aware indexing and had long short strategies, 130-30 strategies, and implemented some of those tax-aware fashion as well. Even in 2018, the minimums were like $50 million. So the prime broker, State Street, and Pershing and others were really geared towards large hedge funds. So we really, at the time, attempted but couldn't really build a growing business in that environment. And it was really when like AQR paired with Fidelity with lower account minimums kind of launched that off. And the Parametric, Aperio, others had to adapt to that new entrant.
And so now we're blending active management. So they got to choose those longs and they got to choose those shorts. And so they have a lot more flexibility. We're in this bubbly time. People are sitting on a lot of risk. What do I do about it? Well, I can get some alpha. I can get some tax alpha. Is this an appropriate solution?
There's this hierarchy from ETF to direct indexing to tax managed long short. And it's from, simple to more complex. So the really great thing for investors and advisors is now there's some additional tools when you have a liquidity event in a business, or you need to diversify a concentrated stock, or you have kind of portfolio that has sustained short-term gains being realized. None of these things eliminate taxes. They're all kind of deferring them into the future, where you can either do tax efficient withdrawals, or you can gift to charity, or you can get a step up basis at death. But it is quite interesting. You start passive, you take a little bit of active risk in a direct index, and then getting fully back into kind of long short active management with the tax-aware long short.
Because I mean, the big topic with long short is there's additional complexity for sure. You have to learn what margin and shorting is. You have to learn about things like financing costs and borrow fees. And in your paper, the work in progress paper, you talk about suitability. This is really like, what is the right tool for the job? And then I think there's a paragraph, maybe near the beginning, if I'm recalling correctly, that says, like, essentially, there is no dominant solution. It's really investor specific.
I'm very confident that I'm going to get a peer reviewer from this paper that says, but you didn't find the optimal point of leverage, and they're like, no, you missed the point. It's like investor specific. But I think that, yeah, what we're trying to do is create a framework for kind of identifying that sweet spot. So the title of the paper is Direct Indexing or Tax-Aware Long Short. What is the leverage sweet spot for tax-aware investing? And so, again, kind of looking at the framework, like first of all, there's just a decision framework, which is the investor going to be comfortable with active management? Do they have the gains that they need that are going to make this extra tax management valuable? And then are they comfortable with the extra operational complexity of being long and short, using leverage? Are they aware of those risks and comfortable with them? So I think that's the basic decision framework. And then in the paper, we create some tools that says, okay, what is your particular gain profile? What is your projection of gains in the future? Is it kind of a small annual gain that's mostly long-term? Is it a higher level of gain each year that has more short-term gains? Is there kind of a one-time event at year 3? Like, what is your picture of your tax liabilities and your projection of tax liability in the future? And now, instead of like almost all tax benefit or tax alpha calculation out there, kind of assume like, if we generate losses for you, you'll be able to find a home for them. And we'll actually assume that all the gains that you have realized elsewhere in the portfolio are indeed short-term at the highest benefit. So, if I go to a 200, 100 long short, very aggressive strategy, I'm going to produce 7% tax benefit for you a year forever. Well, that really assumes that you have the short-term gains to offset. If you don't, then, all those losses will just carry forward and build up on your tax return. They won't really get used, and you won't really get the tax benefits, but you will pay the extra fees and borrowing costs, and you will deal with the extra active risk as well. So the framework we choose, like, hey, you tell us the gains, we'll match the gains with the losses that each strategy generate. We'll calculate the loss carry forwards, and then we'll calculate a tax benefit after fees and after borrowing costs, after taxes. And so that kind of allows us to say, like, if you're you just have a modest gain profile, actually on an after fee and cost basis, direct indexing is better in some cases than a 130/30 or a higher leverage strategy. If you have like really intense gains every year or a big gain event, then maybe one of the higher strategies go.
Yeah, so this is, I think a lot of folks the paper does something, concrete and valuable to me, which is that it really brings cost and risk and all different flavors of risk into the front of the brain, and, I think that should be a more material part of the discussion, the allocation discussion. You got a retirement coming up, and what's gonna happen next?
Yeah. So planning to leave Parametric, Morgan Stanley in February of 2027. I've been there 20 years, 31 years of my career. I'll still continue to be the editor of the Journal of Wealth Management. I'm still going to be, involved in tax management worlds and writing and thinking. I'll also, likely be involved with the computational finance program at the UW, University of Washington here in Seattle. So I'll still be involved, but just not in a kind of a day to day on the front lines basis. You mentioned concentrated stock. And I was going to say that, thank you again for submitting papers to the Journal of Management. You have a couple papers on concentrated stock showing up in the journal this summer. We created a whole special issue on it. So we have papers from my colleagues at Parametric, papers from Nathan Sosner and folks at AQR, and from advisors as well. So a lot of great topics around variable prepaid forwards, how to integrate long short with charitable trusts, and just the whole, like, what do you do with concentrated stock and how do you look at it through a goals-based framework? And there's also some interesting kind of behavioral papers in there, one by Mayor Statman in particular. It's like, maybe concentrated stock's not so bad. And so, like traditional thinking is like, oh, diversification is better and concentration is bad. You got to figure out how to get more diversified. And there's other, less, statistical ways of looking at it, more behavioral ways of looking at that, it can make sense for some investors to be concentrated.
There are just so many layers to peel back, like in the world of tax management. And like you said, like it's this third dimension, or I always think about risk and reward is black and white, but you inject tax into it, gives it a little bit of color. That's probably taking it way too far. I really appreciate it.
All right. Thanks, Brett.
Thank you all.
Cheers.
The Albatross is a Tax Alpha Insider production and is hosted by me, Brent Sullivan. Original music is by Paul Roderus, and this is educational content only, not investment, tax, or legal advice. Hire a credentialed professional for personalized guidance. See you next week.